So this analysis is all about Applied Digital's huge strategic pivot, focusing entirely on that massive $11 billion 400-megawatt lease with CoreWeave.
A huge deal.
It really positions APLD as a key infrastructure provider for the AI boom. And the material does a great job breaking down the deal structure and the strategic advantages.
Yeah, the quality of the foundation here is really strong. It makes a very compelling case for this power play thesis, you know? It correctly identifies APLD's edge, the scarce grid capacity, and crucially, the directed-chip liquid cooling. I mean, that's really the only way to handle these next-gen chips.
For sure.
But to really elevate this analysis, I think we need to focus on inoculating the core arguments against some natural market skepticism.
Okay.
The enormous long-term stability offered by that $11 billion 15-year commitment from CoreWeave is a great place to start. But that very longevity presents a major opportunity to deepen the analysis of concentration risk.
That's the pivot point, isn't it? The report right now treats the 15-year term and the fixed payments as this almost purely positive thing.
Well, and you can see why.
Of course. You see that number, roughly $500 million in projected annual net operating income, and that kind of visibility is, on paper at least, just staggering.
But it kind of glosses over the fundamental risk, right? Having a single 400-megawatt tenant basically defining your entire financial profile for a decade and a half.
And it's all concentrated at that one campus in North Dakota.
Exactly. You're swapping short-term volatility for massive long-term exposure. 15 years it's an eternity in the tech sector.
Right.
That kind of longevity, it introduces some serious financial vulnerability if CoreWeave's tech stack changes or if their whole strategy shifts.
Or they just want a better price down the road.
That's the thing. The sheer size of this deal gives CoreWeave immense leverage if they decide to renegotiate 5-10 years from now. APLD might be forced to make concessions just to keep 400 megawatts of revenue online. That's a huge exposure that needs to be quantified.
So there's a real opportunity here to tackle that structural issue head-on. The suggestion would be to introduce a brief but robust scenario analysis section.
Right after the NOI visibility part.
Yeah, exactly. Putting that quantification in there would just make the whole piece more robust and show a real understanding of how to manage that core risk.
And to make that really actionable, we should talk about some concrete ways to build that section out.
Absolutely. Okay, so one specific way to do it is to just explicitly compare the $500 million in annual NOI from CoreWeave to the revenue from all the other non-CoreWeave contracts.
Just to visually show the concentration.
Right. And another step would be to, briefly game out some retenancy scenarios. For example, contrast how easy it is for APLD to get cheap financing now, like that recent Macquarie deal, with a hypothetical where, say, only half of that capacity needs renewal after the 15 years.
What would the cost of capital look like then?
Exactly. Proactively hitting those long-tail risks actually makes the bull case stronger because it proves the analysis is exhaustive.
That kind of depth is what takes a report from strong to indispensable. And speaking of that longevity, it also means APLD's competitive edge has to last that long. So let's talk about the second point, challenging the scarcity value thesis by addressing competitive erosion.
The report makes a very powerful claim here in the Power is the New Gold section.
It's a great headline.
It is. And it strongly emphasizes that APLD has this rare asset because move-in ready 400 megawatt capacity is just so hard to find, especially with the multi-year permitting hurdles in North Dakota.
Which is true. Today.
Right, today. Speed to market is everything. The weakness, though, is that the analysis of how long that scarcity window stays open is pretty underdeveloped.
It reads a bit too statically, as if the competitive landscape isn't going to shift dramatically. But competitors, they're not just sitting around.
No, they see the margins.
They see the margins and they're responding fast. There's a very real chance APLD's speed advantage could erode much, much faster than that 15-year contract implies.
So the argument needs to be anchored not just in today's reality, but in what's coming tomorrow.
The suggestion is to really anchor that scarcity value section with specific external context.
Okay, so what does that look like?
It means weaving in data about what competitors are actually doing, or looking at, say, regulatory or local incentives that might speed up grid development in that region, or even adjacent ones. It just adds resilience to the argument.
Facility in 12 to 14 months. The real question is, what are competitors doing right now to close that gap?
Exactly. The material would be so much stronger if it detailed known regional power pipeline projects or maybe state-level initiatives designed to cut that red tape.
If the competition can shrink their timelines from 24 months down to, say, 18, that advantage APLD has starts to look a lot smaller very quickly.
And what about the tech differentiator?
The report is right to point out the direct-to-chip liquid cooling as a way to future-proof the facilities.
Yeah, for high-density AI.
But to really challenge that scarcity idea, it would be useful to expand on whether other major players are publicly saying they're adopting that same standard for their new builds.
Right, because if everyone starts deploying it over the next year or two,
Then APLD's unique technical edge gets neutralized and the supply of future-proof data centers goes way up. It just accelerates that erosion of scarcity value.
that's the level of critical thinking that really maximizes the impact. Okay, so let's move on to the operational side, which is so tightly linked to the financials. The powerful execution narrative, getting build timelines down from 24 months to just 12 or 14, that could be leveraged way more effectively by connecting it directly to the financial de-risking.
Yes. Right now, the operational success story and the financial benefits, they feel like they're in two different parts of the report.
Adjacent but separate.
Exactly. You read about the swift execution getting that first 100 megawatts online by November, and then later you read about the stock being de-risked, the strong buy ratings, and so on.
The link is implied, obviously, but it's not explicit. And the real proof of concept for the whole bull case is that the operational speed is the engine for the financial momentum.
The cause and effect is missing. If the execution is that impressive, it shouldn't just be an operational note. It needs to be framed as the primary reason for the improved financial picture.
Right, the speed isn't just about being on time. Every single month they save on construction is a month of revenue they're generating. It dramatically changes the IRR on the whole project.
So the suggestion here is structural.
Yes, completely structural. Reframe the entire discussion to position APLD's operational speed as the fundamental reason for the better financial metrics. Create that tight cause and effect narrative.
You can almost think of it like a flywheel. The speed proves the model, which unlocks cheaper capital, which lets them build even faster, which proves the model again.
You need to see that momentum in the report structure.
Precisely. So when discussing the strong buy ratings or the price target upgrades, which average around what, $43?
About $43.57, yeah.
The report should explicitly link the rapid energization of that first building to the immediate start of revenue generation. That tangible speed is what gave investors and, more importantly, lenders the confidence they needed.
It completely changes the narrative around that Macquarie financing deal.
That deal didn't just happen because of the big $11 billion contract value. It happened because APLD proved with Phase 1 that it could deliver massive, complex infrastructure faster and more reliably than anyone else.
That execution is the core catalyst.
And the report needs to treat it that way. It moves the analysis from just listing strengths to actually demonstrating the power of their business model. It's a change that would just dramatically improve the whole thing.
To quickly summarize then, this analysis is already a very high-level piece of work. It really captures the scale of the APLD and CoreWeave deal. The foundation is strong.
Absolutely.